ready? You got me running, you got me running, got me running. Shake it, shake it, shake it, baby. Raise your hands up, raise them up.
Hi everyone and welcome. It is Tuesday, the 16th of November, and thanks again for joining us as well. And hello to all the LCMS club members that are in the live call as well. I hope that you enjoyed last night's call as well. And we have had a little bit of movement in the markets too, and also the Forex briefcase account holders. Make sure you check your MAM accounts because I think we're approaching nearly 3.64% currently, and we've still got a few days left of the trading month, guys. So back to formalities though, with the just an introduction. If you are new and you're watching this on YouTube, this is the Forex trade call. We do this daily, presented by Forex Trading Ages. So the currency call, we go through from Monday to Friday at 11 a.m. GMT +8, the currencies as follows. So on Monday, we do the Aussie and Kiwi. Tuesday, we do the Euro. Wednesday, we do the pound. Thursday, yen and gold. And then on Fridays, we do the CAD and cryptocurrency, Bitcoin and Ethereum in focus as well. And there is a little bit of movement actually already on crypto. So we do have the crypto chat as well in the LCMS Traders Club. So there might be some activity there soon. But just to explain, the currency call will go through the market economic updates. We've got key support and resistance levels discussed and trade ideas. And this currency call is going to be very beneficial to both the long-term investors and the short-term traders as well. And here we'll go through what could move prices, the possible trade ideas, and we'll also highlight some potential targets and risks. Also a disclaimer, and that is any information shared during this session is not intended to be a trade recommendation. It is solely the opinion and views of the speaker. So please remember to do your own analysis prior to entering in any trades. That includes the signals as well, guys. Always feel free to ask questions if in doubt about anything as well. We are here and happy to help. So we do have Gimme Back as well, currency strategist at LCMS Traders. And we've got some RBA activities as well that he'll go through. We've got the meeting minutes and we've got Governor Lowe who started speaking a little while as well. So over to you now, Gimme, and welcome back.
All right, thank you, Scott. Yep. So during the previous meeting, okay, from the Reserve Bank of Australia, okay, we know that they have held interest rate unchanged at 0.1%. And then, QE quantitative easing, okay, continued at the current 4 billion Australian dollars per week rate, okay? This will last until at least February 2022, all right? So something new that they actually did the other time, okay, that time during that meeting was that they dropped the YCC, which is the yield curve control. So we didn't really know what kind of discussions went through during the meeting, okay, which was why at that time I was actually telling you guys that we'll just wait for the meeting minutes to see, if they actually provide us with more details as to why they actually decide to drop the yield curve control. All right. So the release of minutes did mention why. Okay. But before I dive into the why, let me just, briefly explain how this whole yield curve control come about and what took place recently. All right. So basically, during the pandemic last year, okay, when it hits, around March, okay, the Reserve Bank of Australia, okay, apart from cutting interest rate to an all-time low, starting this whole QE program of bond buying purchases and things like that, okay, they actually do this thing called the yield curve control, all right, which targets the April 2024 government bonds at a yield rate of 0.1%. Okay, so two motivations behind this introduction of bond April 2024 bond with this 0.1% target. Okay, the first motivation is that it keeps funding costs low across the economy. Okay, second, it reinforces the forward guidance that the cash rate, okay, the interest rate, Australian interest rate, is unlikely going to increase for 3 years. Okay, which was why we at the initial stage of the pandemic, okay, whenever there's the RBA's meeting, we always hear them saying like interest rate will not rise at least until the end of 2023. All right, that was last year. So 2020, 3 years down the road was 2023. Right. So yeah, that's the motivation behind why the government actually came up. The central bank, okay, actually came up with this yield curve control for the April 2024 bond. Okay, so recently, what happened? Okay, especially during the actually from the second quarter onwards, okay, we actually see a stronger than expected inflation. All right, and well, inflation actually rose across the world, right? And so is the Australia as well. Okay, so they actually have been Australia, okay, has actually been having this low inflation rate for quite some time already. Okay, even before the pandemic. All right, but recently during the second quarter, okay, there was a stronger than expected rise in inflation. So that actually led to the market participants expecting that inflation will be rising even higher than expected and things like that. Okay, so all in all, this actually creates some form of uncertainty in outlook of inflation. Okay, because that inflation will make things more expensive in Australia. Okay, so this sort of uncertainty is actually not very good for the economy. All right, so with that, one of the immediate response from the market is that the yield for bonds, okay, Australian bonds, specifically the April 2024 government bonds, okay, to rise. All right, so I think it was back in October, okay, that the April 2024 government bond actually, the yield actually risen to close to 2%, all right, probably like 1.65 and maybe hit 1.7 or something, but it was actually rising. It was actually at, sorry, not 1.5%, 1.65, sorry, yes, 1.65. So the RBA was actually trying to keep the yields lower, okay, to their target, right? So, because of the rising inflation, the market actually, pushes the yield for the April 2024 bonds higher, okay, close towards 2%. And as a result, okay, on October 22nd, the central bank actually carried out a purchase of 1 billion Australian dollars worth of that government bond, the April 2024 bond, okay? This is actually to, push the yield lower. Okay, it actually did decline. That's actually good, right? As planned by the central bank. But 5 days later, on October 27, okay, October 27, there was this release of the Australian inflation reports, inflation data, okay, and it actually showed a very, very positive inflation data. All right, let me see if I have the data with me, and then you guys will know what I mean. All right, just show you guys this. So what you're looking at is the data release on October 27. Okay. Normally, we look at the CPI Q on Q or CPI year on year data, okay, which is on quarter on quarter, okay, for the third quarter, inflation rose by 0.8%, okay, on a yearly basis, it actually rose by 3%. But, okay, keep in mind that the central bank's preferred measure of inflation is actually the trim mean and the weighted mean CPI. Okay, so as you can see over here, for the trim mean CPI, okay, it actually rose on a quarterly basis. Okay, it actually rose from the previous 0.5% to 0.7%. Okay, on a yearly basis, it rose from 1.6 to 2.1%, which actually, falls within the central bank's 2 to 3% targets. Okay, so if we were to look at the weighted mean, okay, we see something similar as well. Okay, on an annual basis, inflation actually rose from 1.7% to 2.1%. which is a good thing, right? Because the RBA has been reiterating over and over again, because inflation has been low. Okay, so they have been reiterating over and over again that for us, okay, for the central bank to actually consider a rate hike in Australia, all right, they will want inflation to be sustainable, okay, to be sustainably achieved within the 2 to 3% targets, okay, at the same time, which inflation has to increase as well, okay. And previously they have said that this is unlikely going to take place before 2024, okay. So that means it's a indirect hint to saying that expect no hike in inflation, okay, expect no hike in inflation before 2024. But then right now, we are seeing that inflation is starting to enter the 2 to 3% range, okay, which is good news, all right? Which is why, there has been some minor change in the rate statement, the forward guidance, okay, from the most recent released monetary policy statement, okay? So refer back to the previous call where I actually covered the whole RBA, what went down during the most recent RBA meeting, and you will know why, okay? So with this strong inflation, okay, coming up, all right, that actually, pushes the, the yields, okay, for bonds higher, all right, for the Australian bonds. Also, the 2024 government bonds as well, okay? But this time around, okay, when the yields actually rose again towards the 2% level, okay, the RBA decided to do nothing, okay? And that actually led to the market speculating that the central bank is likely going to discontinue its YCC, its yield curve control, all right? And with that, the market actually reacted further, okay, by starting to price in several rate hikes by the end of 2022, which is really very soon, okay? Yeah, which is very, very soon because of the rising inflation, the increase in the expectation of inflation to be in next year, okay, next year. So, with that, that was actually the summary of what actually went down from mid-October to the end of October, okay, when there was this whole bond buying saga by the RBA, okay. So with that, okay, let me bring you over to the minutes, okay. I will be sharing this link later, so no worries about getting the link. Okay, let's just go straight to this part over here, consideration for monetary policy. Look for it. So with regards to this, wait, let me to motivation. Okay, with regards to this continuation of the yield curve control, okay, during the meeting, okay, the board, the RBA, actually discussed 3 options for the yield target. First, okay, to continue the target with 10 basis points for the April 2024 bonds, okay, that's the first option. The second option is to adjust the target by raising the target yield, maybe from 10 basis points, which is 0.1%, to perhaps, I don't know, 0.15 or 0.2%, okay? Or shortening its tenor, meaning from April 2024, they can actually shorten it to probably like October 2023 or something like that, okay? So that's the second option. Now, the third option is to discontinue the yield target altogether, okay, which was what they actually decided on it, all right? So for the first option, simple. Over here, it says, members noted that the main argument for retaining the yield target was that it remained consistent with the central forecast for the economy, which accorded with the cash rate remaining at its current level, which is 0.1% until 2024, okay? Now, however, as the risk to the inflation forecast had shifted higher, it had become possible that an earlier increase in the cash rate would be appropriate, okay? Key point, an earlier increase in the cash rate would be appropriate. Now, if it turns out that, an earlier than 2024 increase in cash rate were to take place, okay, then it's pointless to have this whole 0.1% target of YCC, okay, all the way until 2024, right? It no longer serves the purpose, okay? Now, why is it that this earlier than 2024 hike in interest rate a possible situation, a likely situation, right? Like what I mentioned earlier, a rise in inflation. That's one of the main goal, right? Because if inflation were to hit between the 2 to 3% target sustainably, then the central bank will definitely be considering a hike in interest rate. Okay, one reason is to curb inflation, the rising inflation, to make things cheaper in Australia. Okay. Hence, the first option in this case is not viable. Okay, so they have just dropped the first option. Now, the second option. On the second option, the board agreed that market participants could question the longevity of the yield target if it were raised or its tenor shortened. Okay, so basically, if the central bank were to just shift the target, adjust the target to 0.15 or 0.2%, okay, and or adjust the tenor, okay, from 2024, April 2024 to maybe like October 2023, then this action is very questionable by the markets, right? Like, why is it October 2023? Why not December 2023? Why is it 0.15? Why is it not 0.3? There's going to be a lot of arguments and negotiations and things like that going on. So it may actually create more complications in this whole monetary policy decisions and things like that. Okay, which is why the central bank felt that the second option is also not viable. So with the two options out, then the remaining option is to discontinue the yield target, the YCC. Okay, hence they dropped the this whole yield curve control part of things. Okay, so with that, is this a good thing or bad thing? Obviously, it's a good thing. Why is that the case? Because they say over here that in light of the faster than expected progress towards the bank's goal and revised outlook for inflation, okay, which is why they actually chose the third option, okay? So we are seeing faster than expected progress, okay? Not just through our eye powers and things like that, okay? It's because economic data shows that, right? Inflation expectation, like I've shown you guys, it has the preferred measure, trim mean and weighted mean, CPI, has on a yearly basis, okay, has actually hit 2.1% already, okay. Previously, it was at 1.6 for the trim mean and 1.7 for the weighted mean, okay. Now, bear in mind that the previous measure actually take into consideration the very first increase, okay, the very first quarter whereby we see an increase in inflation, okay, after the pandemic strikes, all right? So that is what we call the base effect, okay? In economics, this means, it basically means like sudden change of data due to a strong impact news or strong impact happenings around the world. In this case, the strong happening is the pandemic, okay? Now, after the base effect is actually out of consideration, we are still seeing an increase in inflation. In fact, a higher level increase in inflation, 2.1%. Okay, this actually shows that inflation is more likely, okay, here to stay, and it has been rising very, very, very strongly. Okay, so with that, we are seeing optimism coming out from the Australian economy. Okay, which is good. Okay, domestic economic situation in Australia is very, very strong. Okay, with this rise in inflation, RBA will probably look at curbing of inflation soon. Okay, which is why the market is expecting interest rate hike to take place earlier than previously forecasted. Okay, which is why the RBA has revised its forward guidance, to hint at inflation may actually hit between our 2 to 3% targets earlier than expected, and hinting at we may actually be hiking interest rate in 2023 or 2022. Okay, so yeah, which is why personally I feel that, okay, now that with this set of meeting minutes being released, we are seeing we actually know why the central bank is dropping this YCC and things like that. Okay, it's actually for good reasons. Okay, it's actually it's actually due to optimistic views coming from the central bank. Okay, which is why personally I feel that, okay, I'm actually bullish on the Aussie dollar as of now, as of the release of the meeting minutes. Okay, but keep in mind, all right, if you guys are trading Aussie against any major currencies, okay, yes, it may be the case that the Australian dollar is strengthening because of, you know, this whole set of meeting minutes being released and things like that. But keep in mind, there are other factors affecting the Aussie dollar as well. Okay, one of the ongoing saga that we're actually seeing is the Evergrande saga. Okay, good news, right? Good news. Last week they have just made a last minute repayment of interest to their bondholders. Okay, but that is not the end of the whole saga. Okay, there are many more upcoming payments to be made by Evergrande. Okay, so it's going to be an on and off thing. Okay, this whole uncertainty is going to be pressuring on the Australian dollar. Hence, we may actually be seeing this whole strengthening, this current ongoing strengthening of the Aussie dollar, okay, to be short-lived. Okay, to be short-lived. But personally, I feel that, you know, if the whole Evergrande saga can be more certain, can be more, I would say, predictable, which is not, okay, then yeah, the, you know, strengthening of Australian dollar will probably be more consistent, will be more stable. Okay, but since this is not going to be the case, you know, we have to, you know, look at how the saga actually unfolds itself. Then let's just, you know, keep our, what do you call it, our bias on the Australian dollar, on the strengthening of Australian dollar short term. Okay, so what this means is that if you guys are planning to trade Aussie again, any currencies, yeah, just try to keep it short term, all right? Because unless you guys, you know, want to be caught in this whole fluctuation of the Evergrande saga and things like that, okay? And yesterday I was just speaking to a colleague on iron ore prices. He was actually telling me that, you know, our iron ore price has actually rose higher, okay? And that has also a positive impact on the Australian dollar. It actually will push the Aussie dollar higher as well. So, you know, we have like some reasons to believe that Australian dollar is strengthening. And then here we have the Evergrande saga, you know, adding downwards pressure on the Australian dollar. So, you know, there's this up and down kind of thing. So personally, yeah, just look at what the chart is moving, how the chart is moving before trading, and try to keep your Aussie trades short term. Okay, that's all I have to share for now. With that, I'll hand it back to Scott.
Thank you for that, Gimme, for your comprehensive take on that as well. Separate episode entirely on the price of iron ore and the minutiae and nuances in that regard as well. So David did ask a question here. Now, I'm not sure if it's been answered already, but he asked about if it was true that inflation is desired at an acceptable rate, but it must be a moderate rate.
I'll touch on that later as I go through the euro dollar.
All right, guys. So what I will do now is US dollar was surprising. And we were talking about this, Jin and I, before the call started. We do have the US dollar, and it actually hit 95.50, 30. No, it did. It was 95.53 was the high. I'll zoom in now on the 4 hour. We are seeing a small pullback. And I mentioned this in my morning market update, where we've seen some buying back down in the 95.20. So in regards to this pullback and where I see it, that, you know, very likely is some more to go here. We are very extended. This was a little unexpected how this played out. There was some opportunities as well that we did discuss. The last night's trade call is up as well. And also Wednesday's last week is up from the evening trade calls as well, from the live trade calls. Now, just down to the 1 hour. So we are seeing, really, we've got some time until the US news comes out, and I'll quickly just go to that as well. So we've got the economic calendar with Forex Trading Asia. Now, one thing to take note of, there was one piece of news out last night. We had the NY Empire State Manufacturing Index. They did come in quite a bit higher than expected, and also the previous month as well. But we really did see a breakout on the US dollar. And I just want to go through now. For later today, we do have, I'll leave the euro for Jin here, but we've got the core retail sales. We touched upon this yesterday. And I thought really the US dollar was not going to do much. It did pick up last night as well. So with this, we have seen some pairs, weaken against the US dollar as well. So now's just the time to just really allow it to either just go sideways or come back down a little bit. There would be very unlikely scenario right now for the US dollar to move higher again, but it really does look like we've talked about 96 as a potential target for the US index, and that's in focus right now as well. So just quickly now, with the news, again, we are expecting the retail sales and the core retail sales to come in a little bit better than expected. And really, that would be on watch. So if we can ideally see a bit more of a pullback on the index as well, that would be ideal, because then that just offers a bit better value for entry as well. Quickly, I want to touch upon the US 10-year Treasury bond yield as well. And this has spiked a little bit. So this is around 3 months of price now as well. So essentially what this means is that when we've seen this elevated, there just is some concerns that interest rates are coming up sooner rather than later. So as we see this, there's just an increased state of concern in the markets, and equity markets as well have been flat, but are very high. So it's still, nothing is really happening quite yet to suggest panic. So US dollar is still moving high though, is my thought. And what I will do now is end that. So US dollar, guys, I'll keep everyone updated in the chat in the USD section as well, the LCMS Traders Club. And Gim has just said the RBA rate minutes. But the euro is in focus right now, guys, with Jin, and there is a little bit going on that pair as well. It did break down. So I'll let Jin take us from there. Thanks, Jin.
Thanks for that, Scotty. So a lot of info shared by Gimme and Scott. So putting it all together, I mean, the 10-year Treasury yield analysis, the current rumor or the current thought is that the US or the FOMC could be more likely or to push forward their plans to increase rates, especially if we do see a uptick in these, in the retail sales numbers tonight from the US. So, if we do see a increase from a 0.7 to a 1.2% tonight, that could increase the indication of further inflation, which also could mean that the FOMC will be more likely to increase rates so that they can tame inflation a little bit more. So if the US FOMC increases rates, then we're going to see some further strength to that US dollar. With that said, considering the euro dollar, the euro GDP to be released today, later today at 6 o'clock, we have the euro GDP numbers. No change there, but bear in mind that the eurozone, many countries in the eurozone is going through a little bit of a wave of COVID cases again. That's also one of the reasons why we saw the euro dollar drop significantly overnight. In addition to that, we're also considering Biden's treasury bill that got passed, and also the likelihood that the ECB is going to stay and wait and see what happens before they take any action, compared to all the other central banks who have indicated possible rate increases in the near future. With that as well, on Wednesday, we do have CPI numbers for the Eurozone year on year staying at that 4.1%, core CPI year on year staying at a 2.1%. So with that in mind, anticipation is that inflation is increasing, but it's slightly in control. The question we've just had in the chat is whether, where was it, just to get the wording, whether inflation is desired at an acceptable rate, it must be of a moderate rate. At this point, inflation has kind of run a bit hotter than everyone expected, but central bankers are considering this as a bit transitory. They've been able to take actions if they're ready to, but at this point, they're all holding off, waiting to see what's going to happen. So inflation should happen at a moderate rate, but if it currently running out of, is running a bit hot, it's still acceptable to the central banks. With all that put into consideration, what this could mean here on the euro dollar chart, here on the euro dollar chart H4 time frame, we've seen overnight it broke below that 1.1436. If you were on the live coaching call last night, we were talking about it breaking past that support towards the 1.1379 support level, which is where it is right now. At this point, I do think that it might see further downside, but on the H4 time frame, this was significantly, the previous candle was significantly outside of Bollinger. So we're looking for it to come back in, test the support level again before possibly heading towards the downside. What I'm looking for at this point is to sell below 1.1361 or 1.1360. You could have a good 100 pip take profit level, maybe a 30 pip stop loss. So 30 pip stop loss, 100 pip take profit towards the downside, a 1:3 or slightly greater than 1:3 risk reward ratio towards that 1.1254 support level. But bear in mind, this 1.1254 support level, the last time we got to this level, if I zoom out and scroll way back in the daily time frame, was back in 2020 July. Last time we came to this point was in 2020 July. You can see that at this level, it's fluctuated quite a bit. It could go as low as 1.1183, but I think that that could be the level where we see a big bounce back up on the euro dollar. So if you're going to trade it down, I do think there's further downside, but we're going to see a lot of volatility at such a low point at this level. With that said about the euro dollar, euro pound is also dropping, being dragged down by the euro dollar. At this point, nothing to enter right now, but if it does break below 8462, then we can see that test of 8419 again. Again, trade idea would be to sell below 8456, a very tight 15-20 pip stop loss for a 30 pip take profit level. This would be something that you want to manage very closely, not a big margin to be trading there. 30 pips, something that you want to manage very closely if you're going to enter that trade. With all that said, considerations will also be for the pound news later, and also how the pound dollar is likely to be moving following on from the news, and also in relation to the euro pound. Short and sharp on my part. Back to you, Scott.
Thanks for that, Jen. And I'm just updating the euro pound trade idea as well. But really, the euro USD and how it's behaved would suggest that that's a little more favorable as well. So again, guys, make sure that you do check out the various sections. We've got the crypto chat, equity chat, and we've got a lot of activity as well on the trading floor. And then the various currency pairs have got their own sections as well. So feel free to reach out as well. Looks like there's some decent opportunities coming up as well. And also, if you haven't already, you are a member, the Forex Briefcase chat is available to get some more information about the managed account service as well, as we approach over 22% for the year so far with no negative months at all. So something to really take note of there. But that is the episode, guys. Thanks for watching. And we've got the pound for tomorrow. Have a great day and bye for now.